So obviously you're part of the direct investments team. Do you want to tell us a bit about what that is in MaxCap and how it relates to the rest of the business?
Sure, pleasure to be here and great to see so many familiar faces here as well on a beautiful day. So I guess a little bit of background on MaxCap. We're in our 18th year now and the business has really, I think, pioneered the non-bank lending space to a large extent and really institutionalised that space over the last 10 years and now we've seen a flood of participants coming into the space. We've got about 100 people around the country. We've got offices in Melbourne, Sydney, Brisbane, Perth, Auckland, so boots on the ground, which is great. And our $8 billion book is primarily made up of credit. But what we did about 6 years ago was strategically made the decision to be able to provide capital solutions across the whole stack. So that meant moving into the equity space, and that was where I came in and we launched an equity platform really in response to our clients and our customers, but acknowledging also that equity is a very different framework that's required, it's a different skill set. So we're sitting on the same side of the table as our development partners, as opposed to that sort of lender-borrower relationship. So it's been a very successful positioning in the market for us, primarily in that sort of mid-market space. And yeah, I think the joint venture relationships that we have, being able to offer those solutions, whether it's on the credit side or the equity side, has been really well received by the market as well.
You know, I caught up with Matt Koo, who's coming next up, and I know you guys had done a direct investment on the Aspire project in Melbourne, and he didn't mind me saying that he'd had an awesome experience with the direct team based in Melbourne.
Thank you, Matt.
How do you see the capital stack playing out this year, and how's the first weeks looking? You know, we've got obviously the rate cut yesterday. One of the main things we do at Urban is monitor everything we can about the broader resi markets, the value we provide to consumers. And what we've noticed is in February, we've seen in the 6 years since we've been monitoring the market, there have been more new projects advertising anywhere. So we look everywhere to see what's going on. The biggest jump we've ever seen since we've been monitoring it in terms of new projects coming to market. What are you guys seeing?
We've had a really exciting start to 25, which is great after, as you say, survive till 25. I think it's now just go big in 25.
Yeah.
But yeah, we've had a really exciting start. We've had already in 6 weeks, we've had 3 projects top out construction, which is a really great milestone to achieve in a very challenging construction environment. And they are across, one's a student accommodation tower in Perth, one's a large resi project here in Sydney, and one's a downsizer project in Melbourne. So, across the country, we're starting to see those milestones being achieved, which is really exciting.
Yeah.
Clearly, the rate cut, the commentary earlier from the agents around the positive sentiment, the catalyst for change, the train leaving the station, we're all, I think, on board that train, and we all want that train to get a bit faster. That's really exciting, and I think that we, certainly on the equity side in particular, and our business swings, which is great. We can hedge between the credit side and the equity side depending on what's happening in the market. The last couple of years has absolutely favoured the credit side of the business, and on the equity side we have been under a lot of pressure. But I think now we know there are less unknowns in that now. We know the things that we need to solve for through this year, but it's also allowing us to take a really positive view into accelerating into the market. We closed a deal on Christmas Day, which was a nice way to close out the year, and there's more new deals on the horizon.
And so what impact do interest rate changes have for you guys? What does it mean for your developers? Does it mean you see more interest on the credit side, the equity side? What does it mean for you guys as a business?
I think there's a couple of things. One is that there has been such a huge wave of capital that has come for private credit and commercial real estate debt that it's certainly something that we see continuing to be very attractive, even with the rate cuts. But on the credit side, we'll see that positive sentiment driving more project activation, which is great in terms of deployment, but it also there's a lot of competition in that space. It's become a very competitive space, and fortunately we're a leader in that space. Clearly, the rate cuts are going to benefit the equity side as well. And when we look at our feasibilities with our development partners, and it's enough to bring that positivity to the table, and hopefully it'll see the balance of the returns between credit and equity normalise and stabilise back to more historical style returns that the market, I think, is more used to.
As I mentioned to you earlier, I met with the leader of a big non-bank lender business just this morning, and I asked him what are some of the risks that exist related to more private credit coming into the market, and how do they see that kind of world? And he said one of the risks is that when non-bank lenders do both equity and credit on the same deal, and he specifically called you guys out and said MaxCap's one of the examples of people that don't do that, and that's effectively what the market needs to see in order for there not to have that creating issues basically in the market. Why did you guys make that decision, and why is that important for developers?
Yeah, so as I touched on before, I think that managing credit and managing equity, they're two very different skill sets, and so we were very deliberate in creating a completely separate business unit for equity, different governance processes, different approvals, different investment committees, so it's completely segregated. And then on top of that, we recognise that for this to be successful in terms of our foray into equity that started 6 years ago, that we needed to make it very clear to the market that we weren't going to commingle our debt and our equity. And that was important for our ability to secure finance from other lenders. And it was also really important for attracting capital into the business on both the equity and the credit side, so that our institutional investors, our discretionary funds, our SMAs, we have a clear policy that says we won't commingle the two, which I think has really benefited us in the market, having that clarity. And I think that the person you were talking to probably used to work at MaxCap as well, so there's a lot of them around the non-bank space.
Yeah, he might have. So what, if they're a developer in a room and they're thinking whether it makes sense for them to use you guys with the equity side or the credit side, what types of deals make sense for you guys from an equity point of view?
Yeah, so we invest across the full spectrum of the real estate life cycle, primarily focused into development joint ventures and the value add space where we can generate those higher returns. In the residential side, we've got large exposure to industrial and the living sector. We're moving into the healthcare sector as well at the moment. But on the residential side, the most critical thing for us is the partner that we choose to work with, right? So the calibre of the partner, the quality of the partner, the track record, the capability, the balance sheet that sits behind them as a partner, because ultimately for us, doing one deal with a partner is not a waste of time, but it's inefficient. We want to be able to do 2, 3, 4, 5 and more. Yeah. And I think 70% of our book is repeat business at the moment. So firstly, it's the quality of the partner. That's the most important decision that we make. And then the second, the thing from there is location. And it's not about everything needing to be premium in the best locations. It's about the right product for that location. We are developing a residential building in Ferny Grove in Brisbane, which is out at the end of one of the train lines in suburban Brisbane, but it was the right product for the right location, and it sold out within, I think, 3 or 4 weeks when it was launched, because that market was crying out for that style of product. So it's not necessarily about being the biggest and the best and the most expensive, but for the right product in the right location that the market is demanding. That's the most important thing for us behind the partner piece.
I think most developers like running their own race to a certain extent, and how does the kind of interface from a relationship point of view? How often are they talking to you guys? What's the kind of cadence that surrounds? Are you guys feeling comfortable to protect your investment and having kind of confidence in the project?
Yeah, so again, different to the lender-borrower relationship on the credit side. A lot of the time it's a daily touch point, right? We might be chatting each day. You've got the formalities of monthly meetings and all of that, but it really becomes a highly engaged cadence that we have. At the same time, we're very careful in our JV partnerships to acknowledge that the reason we've gone into a partnership is because of the capability of our partner. Yeah. So we're not trying to overstep, we're not trying to tell them how to do their job or anything like that, but the ability for us to constantly communicate is critical to things moving forward. And I think the other thing for us is that because of our national exposure across all the different markets, all the different sectors that we're able to have because of the joint venture model we have, we're able to bring some of that value and insight to the table and bring ideas that we're seeing on other projects, maybe in other sectors, whether it's on construction, issues or challenges on the construction side, whether it's value engineering. We can bring some of that IP to the table and ultimately add a lot of value through the process. And then also on the financing side, our depth of relationships in terms of lenders in the market, banks, non-banks, whatever it is, that's typically a key role that we play in our joint ventures as well. So I think it becomes a cadence that you would expect between a true partnership.
I guess, like you said, you kind of want to be working with people on an ongoing basis, and the cost of customer acquisition, I'm sure, is high in your world to kind of onboard and assess a new partner. So you really want to be doing many deals, not just one. And on a final kind of note, was there any tips or advice or things that you think people in the room should perhaps be aware of coming into 2025?
I mean, we all know that we're in a housing crisis. We all know there's a major supply issue. I think we're really excited about the diversification of the living sector. So not just being reliant on build-to-sell projects, which are, I tip my hat to every build-to-sell developer. It's a bloody hard job. The advent of co-living, build-to-rent, land lease communities, student accommodation, for a long time, these areas were seen as probably alternatives, whereas now they're being much more heavily institutionalised, and that's been very appealing for us. So I would certainly encourage people to look at the spectrum of the living sector and how do we contribute to the supply in that space, and it doesn't have to be homogenous. There's lots of different ways we can do that. I think that's quite exciting, and then ultimately that's going to lead to more capital coming into the market as well and being available for those projects. So that's certainly something that we're excited about as we move forward in that space.
Appreciate it, mate. Thanks for sharing your thoughts.